Quantitative Momentum is a financial guidebook that delves into the strategies behind momentum investing, which involves selecting stocks based on their past performance in hope of capturing gains from their continued upward movement. The book provides readers with a systematic framework for identifying stocks with the potential to yield high returns, backed by empirical research and statistical evidence. Here's our pick of top 10 insights from the book. 1. Momentum investing is based on the empirical observation that stocks which have performed well in the past tend to continue performing well in the short to medium term. All right, so hang on to your financial hats, because here comes a shocker. It turns out that stocks are kind of like that overcaffeinated friend who keeps posting their marathon training on Instagram. Once they start running, they just don't know when to stop. Yeah, that's momentum investing for you, playing on the hot hand fallacy without the actual fallacy part. Why? Because historical high fivers keep high fiving in the stock market's mirror for just a bit longer. So the clever money says to buddy up with these overachievers of the ticker tape. But remember, even the Energizer Bunny runs out of juice eventually, and so do these stocks. Timing, like in an awkward high five, is everything. 2. Psychological biases like the herding effect and overreaction to news can create and sustain stock momentum. The irresistible pull of the herd. We just can't help but follow the crowd, can we? When it comes to picking stocks, it's as if we're all lemmings at a cliffside rave, oblivious to the dangers of groupthink. Now, while our little furry suicidal friends are actually quite misunderstood, they don't intentionally jump off cliffs, folks. Investors, on the other hand, often dive headfirst into irrational decisions. The herding effect makes us think, if everyone's buying, it must be good, right? Then there's the news. Oh, the sweet sensational news that sends stocks soaring or plummeting on the whiff of a headline. Overreaction much? But here's the kicker. These behaviors, while they might seem like the market's mood swings, actually help sustain momentum in stocks. It's finance fueled by psychology with a dash of mass hysteria, stock market edition. Keep your wits about you, and maybe, just maybe, you can ride the wave without wiping out. 3. A dual momentum approach, combining relative and absolute momentum strategies, can yield better risk-adjusted returns than using either strategy alone. Imagine your investment strategy as an all-star culinary duo, where absolute momentum is the meticulous sous chef, chopping market trends with precision to avoid downturns, while relative momentum is the fiery head chef, seizing the hottest stocks and adding spice to your portfolio. When these two combine, you're not just avoiding the burnt toast of market downturns, you're also savoring the Michelin-starred risers. This dual momentum approach is the fine dining of investing, a well-balanced meal that can lead to a more satisfying and less indigestion-causing financial feast. Bon appetit, investors. 4. Risk management is critical in momentum investing, as momentum stocks can crash harder during market downturns due to high volatility. So you're riding the high-voltage roller coaster of momentum investing, making those eye-watering gains when the track ahead disappears in a market downturn and your portfolio does a nosedive impression worthy of an Olympic diver. That's the sneaky flip side of these turbocharged assets. They're like that fair weather friend who's fab at parties but vanishes at the first sign of an emotional crisis. This is where your financial savvy dons a superhero cape. By deploying risk management strategies, you're not just feathering your nest for sunny days, you're crafting an all-weather fortress. It's about balance. Think less living on the edge and more wisely walking the tightrope, with a safety net made of diversification, stop-loss orders, and regular reality checks. Keep the thrill, ditch the spill. 5. Momentum investing benefits from a systematic approach over a discretionary one, as human biases can negatively impact trade execution and performance. All right, let's cut to the chase. Momentum investing is like surfing. You need to catch the wave at the right time without wiping out, which can be tough when your brain messes with you. You see, we humans can be emotional creatures, especially when money's on the line. We might hold on to a loser too long. Ever dated someone for longer than you should have? Or we sell a winner just because it had a couple of bad days, like unfriending someone after one awkward text. This is where systems swoop in like a superhero. It keeps you on the righteous path of cold, hard logic. When you build a systematic approach to momentum investing, you're programming the trading equivalent of an unemotional robot that sticks to the plan. This digital pal doesn't get shaky hands when the market dips or turn into a euphoric lunatic when stocks soar. It's like having a Spock from Star Trek in charge of your investment strategy. And let's be honest, who wouldn't want that Vulcan level of cool when dealing with the ups and downs of the stock market? To sum it up, Quantitative Momentum, a practitioner's guide to building a momentum based stock selection system, provides a comprehensive understanding of momentum investing, advocating for a systematically applied dual momentum strategy that combines relative and absolute momentum to achieve better risk adjusted return, emphasizing the importance of risk management to protect against the inherent volatility of momentum stocks. Hope you enjoy our video and the insights it offers on enhancing your investment strategies.